Hi class, today we're going to be looking at chapter 4, problems 9 through 11. I'm sharing with you now problem 9 from chapter 4, problem 9b. And what we're going to be doing in this particular problem is we're going to be calculating the net pay, and we're going to also be looking at each one of the taxes that we withhold from our employees' paychecks, and we're going to look at how to calculate the amount of the federal income tax. So I'm starting with Ocean City College, and it's given its faculty the option of receiving the balance of their contract at the end of September on May the 17th. Faculty can receive one lump sum payment instead of receiving the remaining 7 biweekly payments over the summer. So the faculty are getting paid biweekly. In the summertime, they're going to get a lump sum payment for 7 biweekly pay periods. Use the data given below to complete the payroll register on May 17th. No employee has reached the OASDI ceiling. That's important to note. So that means that all the earnings are taxable for OASDI and HI purposes. Especially for OASDI. There's no ceiling. The ceiling is normally $137,700 that you've learned from the previous chapter, and none of these employees are going to go over that ceiling. All of the employees are taking the lump sum payment, so they're going to get paid for 7 paychecks at one time. The state withholding rate is 2% of total earnings, and there's a city withholding rate of 1% of total earnings. And they've given you information about the link to the wage bracket method tables. And all of these are done basically the same way. So in order for us to save a little bit of time on this video, so we can get through more things, I'm just going to go through one of these. I'm going to go through the first employee, which has the highest amount of biweekly earnings. And right here's your wage bracket table for you to find the federal income taxes. Now, what I did is I created a spreadsheet for you to show you how to do the calculations, because what they're wanting you to do is they're wanting you to withhold the taxes for the 7 pay periods. But in order to make the answers round properly so that Cengage will mark your answer correctly, you have to take the biweekly earnings and find the tax amount on 1 pay period and then multiply it by 7. So I thought it might be good if I showed you a spreadsheet where I made those calculations. So I'm going to look and see if I can find that spreadsheet, if you'll bear with me for just a minute. And I'm going to share it with you now. And so what I did is just copy the information from problem 49B into the spreadsheet, which I've already read to you. And we're going to look at John Matthew. And his biweekly earnings were $3,010. So in order to find the total lump sum payment, you'd have to take that $3,010 and multiply it by 7 pay periods, because they were receiving a lump sum payment for 7 biweekly pay periods. These are 7 biweekly pay periods that I've got listed here. So first of all, take the 3,010 times 7, and that would give you the total lump sum payment. Now, you have to calculate these as I've got it here, or there will be rounding errors. So first of all, what I did is I calculated the tax on one pay period. To do that, we would take the biweekly earnings, which came from cell address D10, and we will multiply that by 6.2%. And that's how you get $186.62. Once you have the weekly amount of tax, multiply it by 7 pay periods, the total amount of tax that would be withheld is $1,306.34 for OASDI. So just multiply these two together to get this amount here. To find the HI tax, you do basically the same thing. Find the tax for one pay period. One pay period is 3,010 times 0.0145, which is your HI tax rate. That will give you $43.64, which I multiplied by 7 to give me $305.55. My FIT tax is done the same way, except we're going to have to figure out what one pay period is for the federal income tax. And so to do that, we're going to have to look at our table to be able to calculate the one pay period for the federal, the one amount of tax for the federal income tax. So we're doing it based on 3,010 as the number of earnings. We're finding it on one paycheck first, and then we'll multiply what we found for one paycheck by 7 to get the total amount of FIT that was withheld. Remember, with FIT, you have to go to your wage bracket tables. That's what method that they're using in this particular problem. And you have to remember that this employee is married filing jointly. So hang on just a second as I switch back to Cengage for the tables. And so we're going to click right here for our tables. And you need to be aware that the employees are going to be paid bi-weekly. And we're looking for the wage bracket method, which is table B. I'm a little fast through these. Let me go back to see where it is. All right. And we need to know the amount that the employee was paid on a bi-weekly basis. And that amount was $3,010. So I'm going to look on this schedule or this bi-weekly payroll period. I'm going to look to see if the first table, the amount would not be located on the first table. Remember, we're looking for $3,010 in wages. And so it will not fit on this table here. So I'm going to go to my next table. Oops, sorry, went a little fast there. Semi-monthly, I don't want that one. All right, Let me click on this one and see if it'll work. This is the second biweekly table. And we're going to find the amount of our salary where it falls in between these threshold amounts. So the amount of the salary was $3,010. So it falls in between these two. $3,010 falls in between 3,005 and 3,035. I've got to know whether what the marital status is of our employee, and they are married filing jointly. So the amount would be $233. So I'm going to go back to my screen. Let me see if I can get back to a new share here. I'm going to go back to my Excel problem. And that's where the $233 came from. It came from that wage bracket method. The person was married filing jointly, and they had a total biweekly earnings of $3,010. So you look up on the table, the wage bracket table, and you'll get the amount of $233. Now remember, this is just for one pay period. They're going to have 7 pay periods. You got to multiply this out to get 1631 as the amount of the total taxes that would be withheld from this person's paycheck. Now, you also need to calculate your state income tax. And the state income tax rate for this state was 2%. And so we're going to take the 3,010 and multiply it by 2%. That's how I got $60.20. We're going to multiply that by 7 pay periods to get a total amount that would be withheld for the state income tax of $421.40. Your city tax was 1%, and it's 1% of $3,010, which will give you $30.10. We're going to multiply that $30.10 by 7 to get the total amount of taxes withheld. So in Cengage, they want you to record the total lump sum payment, the total tax for John Matthews for OSDI, HI, FIT, SIT, and city tax. Then what you will do is you'll calculate the net pay, and you will find your answer by taking the total lump sum payment and subtracting out each one of these tax amounts. What's left over is the net pay. And then what you would do is you would transfer these amounts into Cengage. And that's all you do for this particular problem. Notice in red here, I'm going to emphasize this to you again, because I know that the easier way to do this would just be to multiply 3,010 times 7 and then do it by the tax rates, but you'll get a rounding error and you will be aggravated. So don't get aggravated, just follow what the instructions are. And I emphasize them in red here. And I wanted you to know that you are calculating each tax withholding for each pay period first, and then multiplying by the number of pays. And that's the only way you can make this work out without a rounding error. So I'm going to go on to the next problem on my Excel spreadsheet. You can see down here on this tab, I've got one for 410. I'm going to click on that, and it'll bring up the chapter 4, problem 10. And again, I copied this out of Cengage. These are your B problems. And it says the Harrington Company is given each of its employees a holiday bonus of $250 on December the 13th, which is a non-payday. The company wants each employee's check to be $250, and the supplemental tax percentage used. The supplemental federal withholding tax or income tax is 22% on these problems. The supplemental tax is 22%. So your federal income tax is going to be withheld at 22% of $250. Nobody has capped for OASDI, so we don't have to worry about the OASDI ceiling in this case. And they want in A, you to find what will be the gross amount of each bonus if each employee pays a state income tax of 3.01%. And so you got to take into consideration that you've got OASD taxes, HI taxes, federal income taxes, state income taxes here. All of those have to be taken into consideration. So to help you to solve the problem, which is really a formula for the grossed up bonus amount, that formula is right here on the spreadsheet. It's your intended payment of the bonus. They want the amount to be $250 divided by, that little slash there's divide by, 1 minus the applicable tax rate. So we have to find the applicable tax rate first. So to do that, what I simply did is I put down all the taxes that were going to be withheld and the rates of those taxes. OASDI is 6.2%, HI is 1.45%. The income tax is a flat income tax rate of 22%. They told you that in the instructions to use that. The state income tax, they also told you in the instructions, was 3.01%. I converted these to decimals and I added them together to get my total applicable tax rate. This total applicable tax rate has to be subtracted from 1 to give you the denominator figure of the formula. So right here where it's got 1 minus the applicable tax rate, that's where I'm figuring it was right here. 1 minus all of these tax rates combined leaves you with a denominator figure of 67.34% or 0.6734. Once you know the denominator, you're going to divide it into the amount of the bonus, which the amount of the bonus that they wanted was $250. So $250 divided by 0.6734 will give you the grossed up bonus amount of $371.25. In other words, if I want my employees to take home $250, I have to pay them $371.25, because by the time the taxes are deducted, you have to make this amount larger than your bonus amount. So this is how you calculate the grossed up amount in order to give the employees a net amount of $250 for their bonus. This is what we'd have to put in. In B, it says, what would the net amount of each bonus check be if the company did not gross up the bonus? Well, if they didn't gross up the bonus, the amount of the bonus would have been $250. and we'd have to take taxes out of that $250. So the OASDI tax was 6.2% of $250, which gives you $15.50. Notice I made a column up here for my rounded amounts because there will be a rounding error if you don't do it individually, if you don't calculate the taxes individually. So make sure you calculate each one of the taxes individually and check for rounding. For example, on the HI tax, the HI tax would be $250 times 0.0145 or 1.45% for HI. When you multiply those out, it gives you 3.625, which you have to round back to 3.63. So I just put the rounded amounts in the column out here to the side, so it'll make it easier to calculate them all when we have to. The federal income tax is a flat rate of 22% on bonuses. So 22% of $250 is $55 even. There's no rounding with that one, but I just put it over there with the rounded amounts. The SIT, the state income tax, is $250 times 0.0301, which is 3.01%. That was given to you in your instructions. So this one also has to be rounded up. So notice where I put it out to the side there and I rounded it up. When you add all of these tax amounts together, the total taxes withheld will be $81.66. So you would take the amount of the bonus, subtract the total taxes that was withheld, $81.66, and that will leave you with a net amount that you paid to your employees of $168.34. So as you can see, when you're given bonuses, you might want to take in consideration what the taxes are before you pay out the bonus. It went from $250 down to $168.34. That's just showing you what taxes will do to your earned income. So to find the grossed up amount, we have to use this formula right here. And so you have to figure 1 minus the applicable tax rate before you can enter in this amount in. And to do that, we found all of our taxes and combined them together, subtracted them from 1 to get the leftover amount, the denominator amount, and then we divide this amount into 250, and that will give us $371.25. That's the amount of the bonus that you would, that's the gross amount of the bonus. And once you take out your taxes on it, then it will end up being $250. So it just depends on what your company wants to do as far as the bonuses are concerned. All right, and then we'll go on to the next problem. And on the next problem, it has to do with a simple retirement account. So I'm going to read the problem to you. We're going to be Samantha Montgomery, and she's age 42. She's employed by Cannon Company and is paid an annual salary of $62,430. She has decided to join the company's simple retirement account and has a few questions. And so we want to answer the following for Montgomery. And they say to round your answer to the nearest cent. For A, what is the maximum amount she can contribute into the retirement fund? For the simple retirement fund, the maximum amount that she can contribute is $13,200. This amount comes straight out of your textbook. There's a table in figure 4.3 on page 4-9 of this textbook that tells you exactly how much the maximum is. $13,500 is the maximum amount that she can contribute to the simple retirement account. The simple retirement account is usually a plan that's set up by a small company with less than 100 employees. And it's a part of the 401k plan for retirement. But this simple retirement plan, you can only contribute the maximum amount of $13,500 into this fund. That's what the employee can contribute. What would be the company's contribution? The company is limited to 3% of the salary of the employee. So what I did is I took 62,430, the salary of the employee, I multiplied it by 3%. That 3% is a given amount in the table in figure 4-3 on page 4-9. That's where I'm getting the 3% amount. So the employer is only allowed to contribute 3% of the employee's earnings. And so 3% of the 62,430 is how you would arrive at $1,872.90. It says, note for items C and D below, round your interim amounts to 2 decimal places. Notice here I've got a column here that says rounded. So make sure that we round those to 2 decimal places, because if you don't, Cengage will mark your problem wrong. So we don't want it to do that. I don't want you to get frustrated with it and think you don't know how to do it. Just be sure you round your answers. And you have to calculate each one of the taxes separately to be able to do this. So first of all, they want to know what her weekly take-home pay, her net pay will be with the retirement contribution deducted. The retirement contribution is deducted from the regular earnings, and you are not taxed upon the amount that you have contributed as far as this simple retirement plan. You also have to know that they are going to want you to calculate the weekly take-home pay with retirement contribution deducted. The marital status is married filing jointly. We're using the wage bracket method to find the withheld amount of taxes. And there's a 2.3% state income tax. So first of all, what we're trying to do here is we're going to try to determine what would be her weekly take-home pay with the retirement contribution deducted. So the retirement contribution is not taxed toward federal income tax purposes. It's only for federal income tax purposes that we would not tax the amount that was contributed to the retirement. There was an annual salary. This employee made $62,430. We're going to divide the annual salary by 52 weeks to get the salary for a weekly basis salary of $1,200.58 rounded up. Notice I've made a column for the rounded amounts. Again, we're going to take that weekly salary, the rounded amount, and place that right here. I just stuck it in here in the rounded column. And then we're going to subtract out the simple retirement per week. So what I had to do is I had to find the weekly amount of this yearly amount that I could contribute to the simple retirement plan. So take 13,500 and divide it, that's the yearly amount, by 52 weeks in a year, and that's how I get $259.62. I actually calculated it here. You can see that in the formula, but then you got to round it to the nearest cent. So $259.62 is the rounded amount that I calculated in this first column. You will subtract your retirement amount that you're contributing per week from the gross amount of the wages to get what's left over that is subject to your taxes. So we're going to take $940.96 and multiply it by the OASDI tax rate, which was 6.2%. That's how I come up with $74.44 rounded. This is my rounded column here. Again, we will take the $940.96 that was subject to the taxes. We would multiply that by 1.45%. So sell on, oh, I'm sorry, I told you a story here. And make sure you do this or Cengage will count it wrong. The OASDI tax is based on the weekly salary amount, not the amount of pay that is subject to federal income taxes. So right here where I've got pay subject to taxes, I really should have put federal income taxes. And the reason why I should have put it like that is because my OASDI tax, you have to calculate it based on the regular salary. Only the federal income tax, you are going to deduct the retirement portion from your weekly salary to get the pay that is subject to federal income taxes. So my OASDI tax rate is based on $1,200.58, the weekly salary before you have deducted the simple retirement weekly amount. So use $1,258 to calculate OASDI tax and the HI tax, but the federal income tax, we're going to use $940.96. And that's because we are allowed to deduct the simple retirement per week from our weekly salary. We only pay income tax on this amount for this person. Now, for your federal income tax, you're going to have to look up the amount on using the wage bracket method. They told you to do that in Cengage. I don't think I copied it down here, but they're telling you that in the problem in Cengage. So make sure you read your problem in Cengage carefully. This $940.96 is subject to federal income tax. We need to know the marital status of this employee, and that's given right here, that they're married filing jointly, and we are using the wage bracket method, and this would be for a weekly salary of $940.96. So I'm going to go to my table. And you're going to click on the table here for wage bracket method. Sorry, it's going to take a second because I clicked on it twice. But hang on. We're going to go to tax table B. It is going to be weekly. I'm going to enlarge the weekly amount. And the amount was, I'll check back just a second here. What was the amount that I had on there? Hold on just a second. It was $940.96. So in the table, I'm going to look for 940. And the amount falls from 940 to 950. And the amount was $49 for a married person that's filing jointly. So that's how I got that $49 there. You got to look up on your table the $940.96 to see where it is found. And this is on the weekly table, and this person was married filing jointly. Once you know the federal income tax, then you can calculate the state income tax by taking the $1,200.58, the whole amount of the weekly salary, and multiplying it by the state income tax rate, which was 0.023. That will give you this amount, and then the rounded amount will be this. So in order to find the net pay, we would take, oh, I see that it's paused. So hang on just a second. Let me get this back here. It's a little confused, I think. I think I lost you there, so I'm going to try to pull it back up. Bear with me just a second. I want to resume share. See if that'll work. Oh, come on. Gotta love this technology. All right, hang on just a second. I'm gonna stop sharing this for just a moment. I'm gonna go back in again. And I'm gonna share it with you once again. And let me make sure that I'm going to the right problem. Okay, you should be able to see it now. I'm sorry about that, class. So getting back to where we were looking at what the take-home pay would be with the retirement contribution deducted. So what we did is we figured up the weekly salary. We would have subtracted out the weekly amount of the simple retirement, and that would have left us with this amount that was subject to the federal income taxes. The OASDI tax was 6.2% of the gross amount without the retirement taken out of it, which was $1,258. The HI tax is also calculated by taking the $1,258 and multiplying it by 0.0145, and this is the rounded amount. In this column here is rounded amount. We got the $49 from the wage bracket table, and then we have to find the SIT, the state income tax, based on the $1,200.58. The net pay then is going to be $1,258 minus $259.62 minus $74.44 minus $17.41 minus $49 minus $27.61. The total amount of the net pay is $772.50. On the last part of this, they wanted you to calculate what her weekly pay would be without the retirement contribution deducted. So we take the weekly salary, multiply it by the OASDI amount, 6.2%. We're calculating the rounded amount of that, which would end up being $74.44. The 1,200.58 times the HI tax rate of 0.0145 will give you $17.41 rounded. The FIT would be looked up on the $1,200.58 this time. You do it the same way we did before. You'd go to the table, but this time you're looking at the total amount of the weekly salary, $1,200.58. They did not deduct the retirement contribution in this case. It's without the retirement contribution. So the amount of taxes went up. And so for FIT, for SIT, the amount of taxes are $27.61. It's really the same as it was above, but because we're basing our OASDI, HI, the SIT tax on this $1,200.58. The only tax that's based differently is the federal income tax. And this time it's no different because we did not subtract out for the retirement contribution. So I think the whole purpose of this problem was to show you that if you are able to get your company to give you some retirement, you can have that taken out before your taxes, federal income taxes, are calculated. So this case being $49 compared with $80 it would have been if you didn't have any retirement that was given to you by the company. Another way to look at this is sometimes companies will offer you an incentive to have some an IRA, and they will make the deductions for you. and the IRA would be made net of the federal income taxes. So in other words, I'm not saying this properly. What I'm saying to you is if you have an IRA, they will deduct it from your gross pay, and then you will pay less income taxes on that IRA while you're working. When you retire and you take the IRA contributions out, then you are taxed at a lower tax break. So it's always a good idea, if you can, to contribute to an IRA. A lot of times the amount that you contribute will help you out tax-wise as far as what you are going to have to pay in federal income taxes. And you'll also have that in your retirement account when you retire. So I hope I haven't confused you too much on this part right here. But the main difference is in this A part, we were deducting a retirement contribution, and this part we were not. And retirement contributions come out as pre-taxed. So they would subtract them from the gross pay, and then you would be taxed on the remaining portion only for your federal income taxes. All the other taxes are calculated on gross pay. All right, so I hope that I recovered this for you, and we'll see you again next time. Bye-bye.